This is The Weekly on ClickOrlando.com with Justin Warmoth.
Good morning, I'm Justin Warmoth. Last month, the Federal Reserve took a break from raising interest rates. It was the first monthly pause since March of 2022 as the Fed works to tame lingering inflation. Most economists, though, believe more rate hikes are on the way. So what does that mean for you and your money? This morning, the stock doctor Lee Siler is here to offer perspective and financial advice for the second half of the year. The bottom line is consumers have been so resilient through inflation and rising rates, and it's making the Fed's job a little difficult. What do you make of the overall theme of what's happening right now?
Well, the Fed's job is difficult, number one.
Yeah.
And the fact that they've got it wrong based on history, always, that's a problem. So, look, the Fed has raised 19 times, and you look at 25 basis point intervals, and they skipped. Okay, the last meeting, they skipped. I don't think it's a pause because based on what the futures are telling us, and that basically is a probability study. The stock market's a probability study. And we believe, based on that, is that the Fed has two more rate hikes at 25 basis points each before probably the full pause. And then they will look at the data. It's going to be data dependent. They've been very clear with that. They said, look, we're going to be data dependent. They want to see the inflation numbers go down, and we're seeing it. It's almost like a rolling recession. We are seeing segments of the economy slowing, but what we're not seeing is consumer spending and employment. That's still roaring.
Yeah, and it's such a lag. Like the data is so, it's lagged. It's a lag.
Rear view mirror.
It's a rear view mirror, and so it's not necessarily indicative of what's happening today.
No, absolutely.
And that's
correct.
important to point out too.
Well, and that's where we're starting to see the weekly jobless claims.
Right.
Those are starting to tick up. So that's more real time. That's what happened last week. And you're seeing it all over. You just read the Financial Times, or read the papers. You'll see that there are more layoffs, especially in the tech and the high paid industries.
Right, and the what is that? What's the significance of that? Because that there are so many different words and that people have made up. Recession, as well as like that's indicating that the people who are being laid off are the higher paid individuals who are those higher paid salaries.
Look, I think what happened is during the heyday over the last several years in technology, they were fat and happy, and they overemployed, and now they're saying, well, let's be more efficient and let's cut earnings, cut costs to increase earnings. And they're under pressure by Wall Street. Wall Street looks at their earnings estimates for the big ones, the Apples, the Googles, the Microsoft, the Amazons, especially Amazon. Where are we going to cut costs to meet those earnings expectations? And first, it's advertising and it's employment.
But let's go back to January to now. So if you were to, in January, would you be surprised of where we are as an economy right now, almost to July? Does it surprise you at all?
I would be surprised more of the stock market than the economy. It's two different elements.
Yeah.
We talk every quarter, and we do this show. And I told you last time that the stock market only 4 times in history has gone down 2 years in a row, and that was because it was a severe recession, which we didn't believe was in the cards. So I would have told you, hey, so far year to date we'd be up 4 or 5%. I was thinking total for the year 6 to 8%, a very modest return. Come to find out, halfway through the year, we're up 13% on the S&P 500. But if you look at the other indexes like the Dow, and that's really what people look at. I mean, most news stations say, hey, the Dow is up 200 points. The Dow's only up 2.5%, 3%. Why is that? Well, because what is moving the markets this year? All technology. It's ironic that those technology stocks are laying people off and the stocks are moving up.
Yeah, it is. There are so many indicators too to watch out for, and we have this new data. There's so much pouring in every week, every month. Yeah. But what are the most important ones that folks should watch for?
Well, I mean, CPI is what the Fed's looking at, and PCE, and that's about consumer spending. And consumer spending is going to be absolutely paramount when the Fed looks at that data for their July meeting. So, look, the fact of the matter is, when you look at consumer discretionary, they're doing great. Look at airlines, look at hotels, look at cruises. I mean, I saw a statistic the other day. Carnival has booked 107%.
Just go on social media, you'll see everyone you know is in Europe this summer.
Everyone's going to Italy.
Everyone's going to Italy. Everyone's traveling. Everyone's spending money now. But keep in mind, they've made this is not. They don't. You don't just on a whim go to Italy.
No, it's been planned.
So it's been planned. It's been budgeted.
And they have money.
And they have money.
They had money, they got their payments from the government, they got their PPP money, whatever they got. I mean, look, I know business owners out there are held on to that PPP money and now they're using for other things because they've gone through the difficult parts. So look, the economy, and that's what the Fed wants to see. They want to see a slowdown. They want to see employment rise. I think the Fed's looking to see I think they'd be really happy with a 4.5% unemployment versus where we are now, sub 4%. I think they'd be happy with that. That would get them towards their target at 2% inflation, which, by the way, I think is going to be very difficult to achieve, especially as minimum wages continue to rise.
Yeah, you've been saying that 2% seems
I think it's unrealistic.
way too lofty. Yeah, unrealistic even.
Yeah.
But that's the goal.
I think
does that change at all?
I think they say 2%, they'd be happy with 3%.
Okay, so that's what because the rates, everyone's like, okay, where am I seeing it the most? Where am I being most impacted? Obviously, mortgage rates, credit card, APR is another one.
And that's what the Fed wants. I saw a statistic this morning that mortgages are up month over month, but down 21 mortgage starts.
Yeah.
But down 21% year over year.
Right.
And look, one of the big reasons why there is still a shortage in housing out there is because if you have a 3.5% mortgage, you're highly unlikely to trade, if you need a mortgage, to go to a 7% mortgage.
It makes no sense.
It's cheaper to keep her.
So yeah, so until the supply comes back,
right?
Or it's the you will not see.
And that's why you're not seeing,
drastic.
You're not seeing the collapse in housing prices.
Right.
Yeah, you may be down, especially area specific. You may be down 5%, maybe 10%, and maybe you're not getting that big time above asking price, but you're still hanging in there as far as prices is for housing.
And which in turn then makes the demand for apartments and renting.
And that herein lies the problem, because
Yeah.
part of that PCE and the CPI are rents. And when you're still seeing, I hear stories, somebody renting a 1-bedroom apartment in Maitland for $1,950 a month.
Where? Because I'd like to know. Seriously though, it's insane here in Central Florida to find something, that even if you go back, I was thinking about my rent when 5, 6, maybe 7 years ago, and it is significant. I'm like, that does not exist today.
And here's the other thing, is that the buying power for housing has gone down.
Yeah.
If you could afford a $600,000 house back 2 years ago when rates were 3.5, that buying power now gets you at $475. So what kind of house can you buy for $475 versus $600? It's not the same house.
Right, no, it's not. And what factor, when we look at the overall inflation data, the number that the CPI every month, how much of that is driven, though, by shelter?
It's quite a bit, actually.
Because you're seeing gas prices are down, food prices are coming down.
It's quite a bit. And between energy and shelter, that's a big percentage of it. And here, the other thing is, the stock market's not helping the Fed either. Because the Fed wanted the market to go down. Guess what? The market's gone up. And when people see their portfolios up 8, 10%, they feel a lot more richer. And they have a tendency to go out and spend. They feel okay about that. Versus last year when their portfolio was down 20%, it's like, you know what, I really don't want to go out and buy that new beach house because our portfolio is down 20%. But now they feel better about it. So it's basically counterintuitive, the stock market versus what the Fed wants.
Why so much optimism? Is it just the data that we're getting from the consumer resiliency because they keep spending, employers keep hiring?
Look, the consumer is wanting to have experiences now. And if you notice, that's what they're spending money on.
Yeah. We're
starting to see numbers from Target and Walmart and Costco. They're starting to get, but it's still the experiences, the trips and the travel, although I saw a statistic yesterday that money for those leisure items will start to run out by the end of the year. So I think that you're going to see things change significantly, especially if the Fed has 2 more rate hikes. So that means, like you mentioned, credit cards. Now that 26% interest in your credit card goes to 26.5 or 27.
And throughout the Fed's rate hikes, there have been differing opinions on the prospects of entering a recession. Coming up, the stock doctor will give his take and the different scenarios that could play out. Stay with us.
This is The Weekly on ClickOrlando.com with Justin Warmoth.
Welcome back. Over the last year, analysts have warned a recession is going to hit the United States. But despite the Federal Reserve's aggressive streak of interest rate hikes, Consumers keep spending, employers keep hiring, and the American economy is still managing to grow. So given all the positive data, is a recession still in sight? The stock Dr. Lee Siler is back now to offer his take on the situation. Everyone has their ideas here. It's like,
the definition has changed.
Will it happen? When will it happen? Has it happened already? Does it even matter at this point?
At this point, it looks like the market is pricing in a very mild recession. But yet, we haven't seen, look, we had an inverted yield curve since March, of 2022. So it's been over a year. We've had 2 negative quarters of GDP. So all that out the window. But again, until the NEBR decides we're in a recession, we're not in a recession, because that is the group that makes that decision. So the Fed thinks that they're trying to avoid, and they call that soft landing, to avoid a recession. The market is telling us we see no recession. We were supposed to see an earnings recession. Remember, we talked rolling recessions. We're supposed to see an
Explain
earnings
recession. Explain what that is. It's a piece. It's like not all at once, essentially.
Segments of the economy.
Right.
Real estate, look, commercial real estate in a recession. All right, we're seeing a lot of these companies are forcing people to come back to work. Why? Because they have long-term leases.
Yeah, they have
to.
Yeah.
That's part of the economy that hasn't done well. What you have seen do well, of course, is leisure. Housing may be in a recession because prices have come back a little bit. Look, mortgages are going up. That's causing that problem. But when it comes to other areas of the economy, I mean, people are spending, and they're spending record numbers. All right. Now, will that continue? No. I think that seeing the data from the Walmarts, the Targets, the Costcos of the world, sales are starting to kind of come back a little bit, and the consumer is now not looking at high end. They're kind of changing brands now. That's what you're seeing as far as Target and Walmart and Costco are concerned.
You know, because you talk to companies and you look around and announcements are made like we're not going to be spending on advertising because we're expecting in the near future, or at least by the end of this year, that a recession will be here. But when people see that and they think, oh, okay, I better get prepared. But that's my point. I just want to be clear with folks. It's something that has already happened when it's announced, right?
It's too late.
It's too late.
It's too late. Look, when I say earnings recession,
yeah,
the market was expecting earnings recession this year. That's why we were down last year. Okay,
yes.
So then we come into this year and say, oh, wait a minute, Apple earnings not so bad. In fact, they beat expectation. Amazon, Netflix, all the big companies, and we talked about this. With the market being up like it is this year, if you eliminate the grade 8 or the super 8, which are the NVIDIAs of the world, Meta, Apple, Amazon, Google, those companies, if you take those out of the index, the market is essentially flat. So if you didn't own those big stocks, you really didn't make too much. Like I said, the Dow Jones only up 2.5%.
Right.
So those stocks are what generate. Why are they generating earnings? Because efficiencies, and they make their layoffs, they buy back shares. That all builds their earnings, and that's why the stocks are doing well.
There's a reason that people are heavily invested into those stocks.
Look, you follow NVIDIA,
yeah.
and NVIDIA is a stock that has and that's all about AI.
Yeah.
The stock has been, NVIDIA up almost 200%.
AI seems to be the new electric car. Seems to be the new theme. Yeah.
There's a theme. A couple years ago, anything had crypto to it was going up. Anything that had EV, electric vehicle to it, was going up. And now it's AI. And again, these stocks won't continue their runs. And there's going to be plenty of stocks that aren't going to make it. We talked about SPACs earlier. That was the big theme a couple of years ago. And a SPAC really is just that was a roll of the dice. That was a guess. They had a shell company. Let's roll it into a business. Let's see if it can work out.
Yeah. I mean,
didn't work out.
A majority of them, not so much.
I mean, but the market has grown so much this year when it comes to those companies. I want to just read a couple things. Apple. Apple's market value is as big as the GDP of France. And that's just crazy that one company can be as big as a huge country. Microsoft is bigger than the country of Italy at $2.5 trillion. Google is as big as Mexico at $1.7 trillion. Tesla is bigger than Taiwan. Oh, by the way, Tesla's like 8 to 10 times bigger than Ford and GM and selling a fraction of the cars they sell.
But that is the confusing part, I think, that's why it's so important to rely on someone who has the knowledge to stay on top of you.
Yeah,
for
and
instance.
you know what we do with our portfolio management, we're really trying to have, nobody knows when the market's going to go up or down.
Yeah.
But what we want to try and do is, again, it's a probability study. So let's say we believe that these companies, those grade 8 or the super 8, are going to continue to do well. So let's have a sleeve of that in your portfolio just in case it continues. But if it doesn't, we need to be more diversified so that we can shelter some of that downside and add some protection to portfolios. Everybody should do that, and it's all about risk assessment. And I encourage all your viewers out there to look at their portfolio and say, okay, am I taking too much risk at my demographic, at my age, or at my, not necessarily age, but your personal situation? Maybe you want to retire, maybe you're disabled and you want to start drawing income from your portfolio. So if you're drawing income from your portfolio, the last thing you want to see is just a drop of 20-30%. All of a sudden, oh geez, my income's down that much, I need this to live off of. So everybody has to have a risk assessment, and that's part of what we do in our practice.
I know when we always talk, you say the market looks for good news, and we're looking for good news, optimism. What are you looking towards as we finish the latter half of this year? What are you focused on?
I'm focused on the Fed. I think that the Fed is likely going to raise 2 more times, but I really believe now the market is suggesting again, odds are 6 rate cuts next year, 150 basis points with the rate cuts. I don't believe that. And they also are talking about 2 to 3 rate cuts this year. I believe the Fed's going to give us a Christmas present. I think we're going to get, and this is just speculation, I think we're going to get a rate cut by year's end. And they're going to do that not because we're in a severe recession, because I relate the economy to, have you ever done scuba diving?
I've done snuba diving.
Okay. When you're scuba diving, you have a BC, a buoyancy control device. So what you're trying to do is just float along the bottom, not hit the coral reef. But if you start sinking too much, you want to pump a little air into it. If you're going up too much, you want to let a little air out. That's what the Fed, they're trying to find that buoyancy in the economy. And I believe that's going to start with maybe 1 Fed rate cut this year. But once you get rate cuts, that's a change of monetary policy. And that's where you have that change of direction. And then you'll see, I think, the market really start, because these companies are way more valuable with rates down 150 basis points than they are today.
Right. So the value, finding the value is it's difficult because, especially if you're not like digging through all the
look, the most investors should own mutual funds or exchange traded funds. They shouldn't play in individual stocks, because that's the biggest risk you take. If you own one stock, you have a 50-50 chance of making money. That's it. That's not good odds as an investor.
You also have to time it, or not even time it, but like figure out, okay, am I holding this for 10 years, or am I holding this for 10 minutes?
Exactly. We are you buying to own, or are you renting?
Yeah.
You know, a lot of stocks that we invest in, they're rentals. I don't want to own them for the long term. I don't believe the long-term prospects are that great, but I think short-term are okay. Look,
short-term as in a couple months. Yeah.
Or 6 months or 12 months.
Like day trade,
But Apple has been in our portfolio since 2011. And for full disclosure, it's my biggest holding for clients, my biggest personal holding. I've owned it since 2011. And when I see what Apple's done during that time frame, however, during that 12 years or 13 years I've owned Apple, we've seen multiple 30 and 40% corrections. Multiple. And it's going to happen again.
Now, the Federal Reserve is set to meet at the end of the month, where again, more rate increases will likely be announced. We'll be watching. My thanks to the Stock Doctor for his time and insight this week. I'm Justin Warmoth. Have a great Sunday and a safe 4th of July.